All right, you know what? Can we just hop right into it? Absolutely. Welcome back again to the Velocity channel. We want to make sure that you know the difference between simple interest versus not so simple in paying down all of your loans with the Velocity banking method. All right, so let's just hop right in, shall we? Simple interest, okay? Let's just go ahead and give you the type of definition that I would have liked growing up, right? And that's the definition we can see. Okay, so the definition of simple interest is, let's go ahead and take 21% annual percentage rate. Now, how many of you think that that is a huge interest rate? It's not. You know why? Because it's calculated simply. Okay, it's simple interest. Now watch this. Let's take $5,000. Let's just say you owe $5,000 on your line of credit, right? And it's at 21%. So how we calculate that is like this. Let's take the $5,000, right, at 21%. So 5,000 multiplied by 0.21. Because remember, when you're dealing in 21%, you're going to take 21 divided by 100. Okay, it's going to move over a couple of decimal places. 0.21. So 5,000 multiplied by 0.21 is $1,050 a year. So let's just say you held that money. You held 5,000. It's going to cost you $1,050 for that year to hold that type of capital. All right. Now, let's say you only held it for 3 months. Okay, how do you calculate it then? Well, this is how you calculate it. We take 1,050, remember? Okay, we'll take that 1,050 of the interest and divide that by 12. Okay, that's going to give you what each month is. Okay, now we take that answer and we multiply it by the 3 months that we've held that 5,000. Right? And that's going to give you how much each month, okay, you owe in interest. Okay, now let's do it again. 1,050 divided by 12. Okay, it's going to give you a number. Then you just multiply that by 3, because it's only 3 months, and that's the total that you owe on that interest, on that card, on that line of credit for those 3 months. Okay, did you get that? Let's go ahead and have you look at that so you can go ahead and write it down. Make sure that your bank, and this is, of course, is an approximate number, your bank statement, your credit card statement, your line of credit, the terms and conditions, it's going to be in there how it's calculated. They're going to go by an average daily interest. This is very close to the average daily interest. Okay, so we're going to make sure that we're utilizing this formula when it comes to this simple interest. All right? Perfect. Now let's hop over here to the amortized, to the not so simple interest. Folks, it's so not so simple that I mean, it's a huge formula. I actually have a video on that if you want to go ahead and click that about how the formula is set up, and you can actually plug in your own numbers. If you would like to go ahead and torture yourself, if you're into that stuff, go ahead and plug in those numbers. All right, and see for yourself. But when you're talking amortized, you're talking scheduled, right? You're talking, let's just say it's $863 a month. Guess how much it's going to be next month? The loan is going to be $863 again. But what about next month? $863. Well, wait a minute. Why isn't it going down? No, because it's going to divide that $863 up into the principal and the interest payments. Absolutely. Yeah, it's going to say, well, this one is going to go over here, and this one's over here. This one's going to go over here, and that one's over there. We're going to give you $133 towards the principal, and then $730 is going to the interest. $134 next month. It's going to go to principal. So, hey, you're gaining more in principal, right? It's going towards more in principal. And then the interest, we're only going to be taking $729 of that. And many times the amortized schedule is front-loaded, meaning what? The lender gets the bulk of the interest. Absolutely. So listen, if you want to be a lender, you want amortized loans. Let me tell you something. Is your goal to be a private money lender? You want to be a private money lender, make sure that you're charging amortized interest. And you probably won't get anyone because I'm going to educate them on out of that mess. All right? Listen, that is how you're going to calculate the amortized interest. Man, it goes by a schedule, okay? And it doesn't matter. Like on the credit card, you can pay that down, right? And that's why we utilize it. On the lines of credit, on the simple interest side, you can pay it down. You can pay however much you want, and it's actually going to go towards paying off, all right? Much quicker than the mortgage, the student loan, any amortized loans. But you see, that's the magic of velocity banking, is that we can actually utilize our lines of credit to chunk down the principal so that this number is dramatically reduced. This interest right here, dramatically reduced. Why? Because we've taken a chunk. We've taken a bite out of crime. All right? We believe in taking a bite out of crime with a velocity banking method, and that is how it's set up. So go ahead and make sure that it doesn't matter how many years, right, you pay on your amortized loan and how good you've been, you're still going to owe $863 each month. All right? Each month it's $863. And so what you want to do is make sure that you are doing a debt transfer with your loans, okay, as we've shown in other videos. And make sure that you're doing that. Okay, and you're utilizing your lines of credit, the tools of the bank, to pay down those amortized loans. But that's how it works, folks. Amortized is a schedule, simple interest. You don't have to worry about the schedule. It is calculated so much more simple than the not so simple amortized loans. All right, folks, listen, if you like this video, and even if you don't, go ahead and like and subscribe, right? And leave me a comment, give me some feedback. You know we love your feedback. Do you have a problem? Do you have a concern about your finances? Go ahead and comment below, and we will dedicate ourselves to you. All right? God bless. You have a great night.